Hello everyone, today I want to help explain a fundamental concept in financial planning using RICE for the second time. And the one I want to talk about is asset allocation and rebalancing. So first let's talk about asset allocation. An asset is an investment that makes you money in essence. And there are four main categories that everybody should have some exposure to. The first one is cash. Everybody's familiar with it. It's what you buy and afford your daily living expenses with. It doesn't give you a lot of return. When you put your money in the bank, you barely get any interest unless you're using a high yield savings account. But it is guaranteed, it is secure, it's not going to lose its value. The second one is fixed income or bonds. And what that is you are lending money to an institution or a government entity or a large public corporation. You pay them a certain dollar amount, and for the remainder of the term, maybe it's 1 year, maybe it's 20 years, you are getting an interest rate every 6 months. So that's why it's called fixed income. And there are three main risks associated with this. Number one is if you've ever lent money to a friend, you're familiar with it. It's credit risk. You might not get your money back. If you are lending to an institution or a government entity or a public corporation that has not been managing their money well and they're trying to borrow money to make ends meet, they might not have a high chance of paying your money back. So that's the first risk. You don't want to lose your principal that way. You can avoid that by largely investing in a diversified fund or focusing on investment grade bonds. The second risk is inflation. It's called fixed income for a reason, right? Your income stays fixed. If inflation goes up and you're earning $100 in interest every 6 months, and all of a sudden inflation kicks up, and now $100 is worth $90, you're still only getting that same amount of income, and that's not going to follow pace with inflation. So that's the second one. The final one is interest rate risk. If you've bought a 20-year bond that ends up paying 5%, and 5 years later, the prevailing interest rate has gone up, and now people can buy a 15-year bond that pays 7%, you have a 15-year bond that only pays 5%. So if you want to sell that on the open market, you have to sell it at a discount. So that is the final risk of fixed income. But it does provide higher potential return compared to just cash at the trade-off of having slightly higher fluctuations. The third asset class that a lot of people are familiar with is real estate or real assets like commodities. You can get exposure to it through your home, or you can buy rental properties and rent it out yourself. If you want to avoid the hassle, you can buy a publicly traded REIT, real estate investment trust, that can take care of all of that for you, but it does start behaving like a stock. So you earn money two ways. One is through the appreciation of the home, and eventually if you rent it out to a happy family and they rent from you, it doesn't look that happy. If you rent it out to a family, they will pay you monthly rent and you can earn money that way. And finally, another investment class that people should consider is owning a stock. And stock is just a small portion of a publicly traded company, and the company either provides a product or a service to people, and they do it at a lower cost than they charge, and thus they can make a profit. So here's a factory that takes in raw materials from this truck, and they output a product that they can sell for money. And if you buy a stock and the company does well and its fundamental earnings go up, what's likely to happen is that over the long term, the stock price will reflect the increase in the fundamental earnings power, and you can make money from the appreciation of the stock and through the dividends. But what we've seen is, honestly, a lot of small businesses fail, right? And big businesses also fail. If that happens, your money goes to zero. But it does provide the highest earnings potential from any publicly traded market. Compared to a bond, it provides much higher expected return. But all of these are good investments on their own. None of these are perfect. they're all going to have certain trade-offs for security versus return. So the idea is for your own personal finance is figuring out a percentage for each of these. And I'll use the last case that I discussed for a pre-retiree client. And I ended up recommending them to have 50% of their stock money in fixed income and 50% of their retirement account in stocks. And the idea is they were so scared of investing because they've never had success investing in the stock market themselves that they were very, very fearful. And what they were likely going to do is have a lot in cash and maybe a little bit in fixed income. But I was fearing with this approach that they would limit their long-term growth and they won't be able to fight inflation over the long term. Because they have a home, they already have exposure to real estate. And if they invest through a broadly diversified investment stock fund, they can have exposure to some real estate investment trusts already. So I felt that this was a very simple approach. 50-50 is very easy to grasp. Having half of their money in a safe investment, half of their money in a higher growth investment. And I felt that being easy to understand will help them stick with the long-term plan over time. And since I was going to manage this for them, if they follow my recommendation, I can kind of coach them through having a more aggressive approach to allow them to have the balance of meeting their short-term needs and stability needs, and also fighting long-term costs like long-term care. So this is where the rice comes in. What this family has been doing, and they've never had luck with the stock market before, because what they were doing was always having all of their eggs in one basket. The stock market would be doing well, and they would shift all of their money to a few individual stocks that have been doing well, and maybe they have some short-term gains. But what ends up happening is when the stock market starts falling, they start losing money, they even lose some of their principal, they panic and they go to cash. And when the market eventually rebounds over the long term, they don't see any of that losses being recuperated. So the market starts going up and they start getting optimistic again. They jump back in. Maybe they have some short-term gains from the momentum of the stock market. Maybe they get lucky. But then eventually the stock market loses again and they have less and less money each time they bounce back and forth. So what I recommended them to do instead is to follow this approach 50-50 and always maintaining a balance. So let's say they have their retirement account. Instead of having all of their money all in one basket, let's have two separate baskets. And half of the money in fixed income and half of the money in bonds. And what would happen is if they experience a downturn in the stock market, they lose some money in their stock portfolio, but what happens is we can refill. We can take some of their fixed income, sell it, and buy the stock funds that have been losing value to maintain this 50-50 balance. Now, overall, they're still losing money. Their account has gone down in value, but what they've done now is put themselves in the best position to earn the highest return by buying low. And when the stock market eventually rebounds and maybe they have too much of their money in the stock market, their risk profile has gone up. So what we would do is take some of the stock funds, trim off the profits, and put the excess into the fixed income fund. And how much do you sell? However much you need to maintain the balance of 50-50. Because before we started trimming it off, this maybe was 60%, 65% in stocks, and the fixed income portion became 35%, 40% in stocks. And so you will sell some, trim some off, however much you need to maintain that 50-50 balance. And you also earn some interest over time from the fixed income. You lose some money in the stock market over the short term. You shift it over, you maintain that balance, buy things when they are low. And when the stock market rebounds, and now you have too much stock again, you repeat the cycle and rebalance. So this is an ideal approach. It's very simple to execute. It's very easy to grasp because you're always maintaining that balance. And when the stock market's doing well, you sell some, put it in fixed income to preserve the profit. And when the fixed income is doing better than the stock market, and the stock market's falling in value, then you do the opposite and maintain that balance. So through this rebalancing process, you can't time the market perfectly, but when the market is going down, you are buying more stocks. When the market is going up, you are selling some of the stocks. Buy high and sell low is very, very difficult to do. I don't believe anybody can time it perfectly. But with this approach, everybody can at least take some profits when the stock market is doing well, and when the stock market is doing poorly, and when everything is trading cheaper, you can buy more stocks. So this mix doesn't have to be the same for everybody, right? For if you're younger and you're aggressive and you can tolerate it and you have a lot more years to work ahead of you, this mix can go as high as 100% stocks. But if you're very, very conservative, or maybe you have a short-term goal for 3 years, maybe the mix is half in fixed income and half in cash instead. So hopefully this helps to visualize why rebalancing is important and how it gets done. And if you'll excuse me, I gotta go clean up this mess.